Hey guys, it's the Crypto Cowboy. This is 25th of September. It's about 12:45 here Chicago time, and I want to do a video as per a couple of members' requests in our Telegram room about Fibonacci relationships in Elliott wave principle. I think this is an important subject, and some people use it correctly. Some people don't, and I just want to clear the waters in how I'm looking at them and what are the most common relationships between the waves when we look to count and when we want to project movements or retracements and things like that. So I just want to clear something up, and some of you guys might be beginners, some might be more advanced and already know all this, but basically in the Elliott wave principle we're looking at 5 core patterns, and I think it's important to say this because markets are fluid and fractal, and I wanted to kind of give a general view of how they tie into each other and how this Fib relationships work between the waves. So basically we split this Elliott wave patterns in two. We split them in motive waves and corrective waves. Within motive waves we have the impulse wave and we have the diagonal. Within the corrective waves we have the zigzag, the flat, and the triangle. And everything else in the Elliott wave world, it's basically a combination of these 5 patterns. And the sooner you learn to identify what these patterns are, and the sooner you get more comfortable in looking at them and see how they behave, plus applying the Fibonacci relationships, the sooner you'll be able to trade a little bit more relaxed and better, and just learn how the markets move and why they're making the moves they're making without getting frustrated. So let's just start with the simple impulse wave, which is a 5-wave move. It's part of an Elliott wave structure. Like I said, you can find them on daily, weekly, hourly, minute charts, whatever. But a simple impulse wave is basically a 5-wave move, and you have wave 1, you have wave 2, wave 3, wave 4, and wave 5. And rarely, these moves will be very nicely aligned with each other and in perfect proportion. More likely than not, you will see them that they are, even though they have a nice look to them, the possibility of these retracements being off one another, it's very high. So basically you can have a wave 1 up. So after a full market sell-off, let's say that the market starts to do a retracement, or it's the beginning of a new bull trend, right? So you have a wave 1 up, you come back in a second wave 2. This wave 2 can be quite deep, for example. You have a wave 3, then this wave 4. By the guidelines of alternation, it can be, usually if this wave 2 is a zigzag, this is a triangle or a flat, and then then you have a wave 5. So what are the most common Fibonacci relationship in an impulse wave? And we can take each wave individually. So basically, after you complete first wave 1 up, then those wave 2, more than likely, the most common relationship here is a 618. And I'm going to do this with the software because it's already incorporated, but you can use your Fibonacci retracement tool to do just that. So up here I go in ratio analysis and I just go wave 2 versus wave 1. I analyze that, and you can see that it gives me automatically these Fib levels, 38, 50, and 618. But the most common relationship here is the 618 between wave 2 and wave 1. Sometimes they'll pull to 50, sometimes they'll pull to 38%. It's extremely rare for them to put only 22 or 24%. Usually that means that the market is very, very strong, and it's got basically no time to retrace a little bit more. The buyers step in right away on any dip and they buy it, and then you have aggressive trend to the upside. Usually a deeper pullback happens after a very strong sell-off because the market is not yet convinced that we're embarking on a new bull trend. So more, then you will see pullbacks to 786, even 80%. But obviously we can't go below the origin of wave 1 because then it becomes invalid. But again, the most common relationship for a wave 2 is the 618. Okay, for a wave 3, then you're looking at this wave 3, and this wave 3, it can take several. It can have several looks, and it can be at the minimum. What I'm looking for a wave 3, it's 100% relationship between wave 3 and wave 1. This is the minimum expected move for a wave 3, and because, just breaking a little bit, if it's just 100%, it can very simple be an ABC move up and then we're continuing to move down. But as a first target, you begin with 100%, and then anything above that is kind of gravy in a wave 3. And if you buy multiple positions here, you can unload them as you're reaching the 100%, 161%, and then 261 and so forth, if this wave 3 ends up being very extended. Okay, but the most common relationship between wave 3 and wave 1 is 1618. So I'm going to do this here, and then you'll see that this is the most common relationship. The right here with the green, you can also go to the 2618, and you can also go to 423%. I think it's the next level up. Yes, but that would be an extremely extended wave. Also, wave 1 could be extended, and then then the wave 3s and wave 5 are usually smaller. But remember, wave 3 can never be the shortest wave. Okay, it can be it can be smaller. It can be smaller than wave 1, but it cannot be shorter than wave 5. Then, okay, so it's very important. In this wave, it's the longest. It's not the shortest wave. I'm sorry. So then we go back and we look at the wave 4 pullback. So let me just delete this relationship here. Actually, I can probably, let me just delete this. So we're going to go and take this off, 2V1 and 3V1, okay? And now we're doing a wave 4. Let's see that this wave 3 reaches 161.8, and now we're looking for this wave 4 pullback. The most common relationship for a wave 4, it's 38.2 retracement of this wave 3. So if I do that and I go and I do 4V3, you can see that this 38.2 is it's the one where the market more likely than not will retrace to. And it can be shorter, it can be to 23%, it can be to 50%, but anything longer than a 50% pullback for the wave 4, I'm starting to have doubts. So as a suggestion, please look at the waves for what they are, and even though they're not invalid until we're pulling below the end of wave 1, anything more than 618, even 50%, I'm starting to get worried that it might not be a wave 4, and the market is doing something else. It's got something else in mind. Okay, we got to stop around this neighborhood, otherwise this count could be in trouble. So this is another suggestion of how to place the stops, and when to start getting concerned that your wave count might not be correct. All right, so this is for a wave 4, and now you're pushing up into a wave 5. Again, this wave 5 can be extended. Again, this wave 3 has to be longer. It cannot be the shortest. So this wave 5, if it extends, it can go. Usually, the most common relationship here between wave 5, it's 100% with wave 1. So, for example, if wave 3 is an extended wave, it goes to 1618. Wave 5 would usually be 100% equality with wave 1. So if I put this here and I go on wave 5, I go wave 5 versus wave 1, you will see that 100% comes right there, like that. Okay, at this level, these waves are equal. And that's why sometimes you'll see wave 5 not penetrate and not go. It can be a truncation with the wave 3, although extremely rare, but it's possible. So that's why I always pay attention at 100%. Sometimes if wave 3 is smaller, so instead of a 1618, you get just 127, or you just get 100%, then possibly wave 5 goes longer, and the next common relationship is wave 5. It's basically the whole move between the origin of wave 1 and the top of wave 3. It's a percentage of that, and that is like this. You go wave 5, it's versus 1 plus 3, so it's the 618 between those two waves. That is the move. And the way you do this, you have to use your Fibonacci extension tool to measure this wave 5. So you're going to have to take it from here, from 0 to 3, and then pull back into the bottom of wave 4, and that will give you the 618 relationship up there. All right. Another common relationship is so it's 100%, and then 618, and very literally when you get extended move, it can be 618, 1618, even higher. You can go like that, but these are extremely rare occurrences for a wave 5. Mostly happens in commodity markets. So let me just go back and clear this up. So I'm going to go ratio analysis 5. You can also do a 5v3. It's another relationship you can do. 100% this wave 3 and wave 5 could be equal, as long as wave 3 is not the shortest wave. So when I usually identify targets for a wave 5, what I do is I create a cluster of zones. So I measure different relationships, like I said, between the waves. So I go, okay, where is 100% with wave 1? Where is 100% of wave 1 plus 3? What is the 618? What is the 100% wave 5 versus wave 3? And I'm trying to identify zones of resistance. And then, obviously, you have to wait for the market to confirm it by selling off from those levels and by giving you a strong price confirmation that those levels were hit. See, one of the flaws of the Elliott wave theory is that it lures people into trying to pick tops and bottoms by using these Fibonacci levels, as their guides. And more often than not, you will get trapped into calling a top when the market actually moves higher. So you have to respect the price and let the market develop and let the market move, and don't fight the trend and don't try to call it up just because you have the tools of the Elliott or because you have Fibonacci projections. It doesn't mean a whole lot. It's just, the market has to be respected. The trend will last a lot longer than you think. Moves will last longer, retracements sometimes last longer, even in time or in price. So as accurate as we want to be, and we want to box the market into these levels, we got to be flexible and just wait for the price to confirm this. And this comes with experience. So this is basically the main characteristic of an impulse move and the main Fibonacci relationships between the waves. Okay, now let's look at some of the corrections, and let's just start with the zigzag, and then we'll kind of tie them all together. So if you take a zigzag, for example, and let's say you have a completely 5-wave move up and now you're retracing. So basically this wave A, and I'm going to do this again when we show the move, but this wave A usually pulls back at about 618, 61.8 retracement fib level of the wave 5. Okay, that would be a very common relationship for a wave A to pull back to. Okay, then this wave B in a zigzag goes up 618 of wave A. So if you do that, you go, for example, B versus A, and that's the 618, and then wave C in a zigzag usually equals wave A. So you go C versus A, and you can see that the common relationship is 100%, and then another very common relationship, it's the 161.8 relationship with wave 1. All right, and again, you got to use your extension tool for these. So this is in a very simple, clear zigzag. These are the relationships. Okay, now what you do, let's look at the flat. So I'm going to delete this. So these are relationships onto a zigzag, and then what if this ends up being a flat and it's not a zigzag? So you have wave A down, let's say it's 618 of wave 5, and now you have a strong pullback in wave B for a flat. For this to be a flat, has to move 100% of, at the minimum, it has to move 88.3% of this wave A. Sometimes will be a little less than that. I mean, depending on the markets, and but it's got to be above 80%, because if it's 618, it's probably a zigzag. If it's higher than that and it reverses, it's more than likely will be a flat. And the way you can tell that, it's also by looking at the structure of the waves. So if wave A is a 3-wave move, then you look at B, it's got to be a 3-wave move, and then you'll have a sharp drop down into a wave C, which can come slightly below this wave A, or right at the origin of wave B at the end of wave A. So if you do B versus A here, ratio analysis, you will see that it's 100%, and then let's do wave C versus A. Right here it's 100%, right? So it's a flat. It can come down to 138.2% all the way down here. Also it's not impossible for a regular flat to reach that. And then if this goes up here at 127, okay, then what you have here it's you have an expanded flat, and then you have an A, B, takes everybody out, and then the market moves up, and then you have the 138.2% down here. All right, this is in case of an expanded flat. You can also have a running flat where wave B goes up to 127% of wave A, and then wave C kind of stops down below here at 100%, and then you go up. All right, this is basically a running flat. So you can have a regular flat, 100%, this at 127 with 100 as a running flat, or the expanded flat when the market drops down below wave A, and you can even come to 1618. Okay, these are just guidelines. I mean, you know, the markets are fluid, so you might get spikes down here and just you know, flush people out. So it's you got to use all this in conjunction with the overall structure, with the overall move, and we're going to combine them here in a second. So, all right, these are the flats, and then you also have the triangle. And then the relationship in the triangle are basically 618 between the waves, right? This is a very common triangle, is a contracting triangle. You can have, for example, you can have sometimes this wave B going up higher here, and then, you know, the triangle can look kind of like that, right? When you have, usually they call this a running triangle, where you have to connect B and D, and then you have to connect, you know, right here, A, C, and E, and then, you know, the market moves up higher. So, but the most common relationships here are 618. So you can get wave B up here to do a 618 of wave A, and then you can get wave C to do a 618 of wave A. There you go. That's how it is. All right. Then wave D will be 618 of wave B, like that. And then you have wave E, which is 618 of wave C. So you can see that the moves in the triangle are actually Fibonacci retracements of the previous leg. So wave C, it's in connection with wave A, wave D is in connection with wave B, and wave E is in connection with wave C. These are the main rules onto the triangle. But you can also do, you know, you can do, for example, wave D versus wave C coming down and see where that kind of lands. But usually they're you know, pretty close into kind of the same areas. But more likely than not, I wouldn't get myself, you know, extremely caught up in these. You will see the look of the triangle, and you will see that the market, I mean, you can watch these levels and see, you know, how the market responds, but it will start to get defined once we're not making, you know, lows below A or highs above B, and you know, the market moves over. And this is very common for a wave B, a wave X, or a wave 4, the triangles. Okay, and these are the most common relationships between them. Okay, and then what else we got? We got the combination, right? So you have, so we've done the flat, we've done the zigzag, we've done the triangle, and then we can take a quick look at the combinations, right? Where you have W, X, and Y. So these are nothing else than double zigzag or double trees. So you can have a flat in wave A, W. This X can be anything it wants. You can have a flat in Y, or you can have a zigzag. You can have, sometimes you can have a triangle in Y, but anyway, the common relationships here are, so wave X, it's usually a 618 of wave W. Okay. And then wave Y versus W, it's 100%. And then the other one, which kind of scares people, is the 1618, that it comes down here. Sometimes wave Y would be pretty long, but if it goes more than 1618, I have a problem calling this a WXY, because then this wave, it's out of proportion with wave W, and more than likely it's either that's a third wave or there's something else going on here, then we don't know just yet. So and don't forget, within the structures you have zigzag here. So also you have to combine, you know, this retracement into the 618 with what happens into this lag, right? So X wave, if it's, for example, if it's another zigzag in there, you can go on ABC. So you measure between those waves the 100% relationship, wave C versus wave A, and so forth. Same way when you go down here into the Y wave, right? It can be a big zigzag where you can have an A, and you can have a triangle in B, and you can have C. So you got to combine and multiply those. But basically, this is the relationship in a combination. All right. So everything else in Elliott wave is a combination of these structures. All right. You have the diagonals, and then you have the impulses. You have the zigzag, the flats, and the triangles. So let's just take a complete structure and just look at it and see how you analyze the market based on Fibonacci when you look at it, right? So you take the impulse lag, and then you take a correction, right? And now you have this wave going up like that, and then this is through, and I'm just going to make sure I can show the lines as well. So the preferences here show lines, and then I'm going to do this also, show lines. There you go. And we're going to anchor this here. Okay, so this is pretty much a structure that you have coming down. Okay. You have a wave 1 up, you have a wave 2 down, wave 3, wave 4, and wave 5. So, and then overall, this is nothing else than another impulse. So you go, for example, you start here, you go wave 1, and then I'm going to correct this here. And this is a wave 2, and then it goes up. All right, or this is a wave A, and this is a wave B. So again, you have to look in the overall market structure where we are. And this is why it's important to combine these levels and just kind of look at them, right? So when you do an analysis, for example, between wave C and wave A, you know that the most common relationship for a zigzag, it's 100%, right? Wave C usually equals wave A. But you also have to look at what's the relationship here between wave 2 and wave 1. So if we know that the most common relationship here is the 618, then we got to let the market develop the C lag here, kind of come down into the 618 and see how the market responds to here, right? If it's basically, if it's a 50%, or a 38.2%, whatever it is, let's combine that with the subdivisions into this, into the ABC. Or if this ends up being a flat, it's kind of the same criteria, right? You go, it's a wave A up here, coming down maybe to the 618. It's a wave B, and then you have a sharp drop into a wave C in a flat, and then you go back up higher, right? Or if this goes down in A, you go up in B, and now you come back down in C here, right? For an expanded flat, that's a different structure, and now you go back up. So just kind of study these relationships and look at the moves here, and what this means, what does wave B means in relationships with wave A, what does wave 2 means in relationship with wave 1, and so forth, right? Sometimes the corrections come to the bottom of wave 4 of a lesser degree, right? So if, for example, if this is not a wave 1, if it's a wave 3, more than likely wave 4 that's coming up next comes to the bottom of this wave 4. Right? So we have to pay attention to all this moves inside the structure and the waves to give us a better look for this, right? If you have, for example, this is a wave 3, and this is a triangle, then again, study the relationships inside the triangle, comparing with the wave 4 pulling back. Okay, so this lesson is kind of getting pretty long. It's like we're about 24 minutes in, but I hope I was clear in all my explanations, and I hope this helps. I don't think I have enough time to do a lot of examples here, with the actual market, but you will find these patterns everywhere you go. And like I said, the markets are fractal. You can go from a daily chart. The patterns will repeat from daily to weekly to 4-hour charts, 1-hour charts, and so forth. So this is the beauty of the Elliott wave, is that it gives you market context. It kind of gives you levels, and I think it's a very, very important tool to have in your arsenal, and just know why a move happens the way it does. And if it's an expanded flat, don't be scared. More than likely will stop at that Fibonacci relationship, and you got to watch the levels. So all right, I think I pretty much covered everything, and I wish you guys good luck in your trading. If you like this, just give me some thumbs up, give me other suggestions, everything anything else that you want me to talk about in future videos, and Yep. Subscribe to my channel, come to our Telegram room, and let's get after it. All right. Thanks, guys. Bye.